Let's go to interest rates. Let's talk a little bit about interest rates. All right. So, where do I follow the interest rates? First of all, as we know, the Trump administration would like to lower interest rates, right? They would like lower interest rates for many, many reasons. First of all, it's good for the consumer because we're a consumer spender economy. It's good that auto loans go down, mortgages go down, restart housing again, which has been in a slump for the last 3 years or so because interest rates are so high, prices are so high, affordability index is in the toilet. Credit card rates, interest rates are extremely high, so why not, right? Lower interest rates are good for the consumer as long as they're passed through by the banks. But this is the chart of TLT. TLT is iShares 20-year plus Year Treasury bond ETF. Okay, this is a 20-year bond ETF basically, but it's inverse for some reason. So when TLT is going up, that means actual interest rates are going down. When TLT is going down, actual interest rates are going up. When was the first cut of the Federal Reserve as far as interest rates are concerned? Anybody remember? Anybody? It was last September, folks. It was right here. Right here, September of 2025. Okay, so TLT was 91 at that time. Where's TLT today? Even with the last rally that we had from 86 to 90 almost, which rates have gone lower. This is 20-year, again, this is long-term interest rates. It's not even back to where September was, but since September, the Fed has cut the rates by 150 basis points. So what you must understand here is that Fed cutting the rates means nothing. It literally means nothing because Fed cannot move the long end of the curve. Now, they can do a lot with the short end of the curve, right? The Fed funds rate is being lowered. That's why, by the way, your APY on your Robinhood account sitting in cash, if you have Robinhood Gold, has gone from 4.5% to 3.25%. So what's going to happen now is that Fed and the administration will like lower interest rates. Well, there is reasons the bond market is not listening to that up until the last few days, by the way. The reason for that is our national debt is about to hit 39 trillion, and it's estimated that in next by 2030 we're going to hit there was some number like 50 some trillion dollars, which is absolutely ridiculous, but we'll get there because we have no austerity, we have a broken fiscal policy, and then we have a broken monetary policy that follows broken fiscal policy. So Fed can do whatever the heck they want. Fed long bond market doesn't listen to the Fed. With all the power the Fed has, yes, granted, many people say don't fight the Fed. I agree. But the Fed cannot do anything about the long-term interest rates. They can manipulate short-term interest rates. That's a fact, and which they're trying to do. But in order for the long-term interest rates to go down, the country needs austerity. The country needs to understand that we cannot just print and spend. And consequently, here we are. We're about to hit $39 trillion in the next 3 weeks. Well, national debt is there because we like spending money that we don't have. So our total receipts, income into the treasury per year, including obviously taxes, corporate taxes, and all that stuff, in individual personal income taxes and everything else, is about 5 trillion. Well, our budget is 7.5 trillion. Well, there's 2.5 trillion deficit there. So where's that money going to come from? Well, we don't have it. So what do? We print it and we spend it. Well, consequently, what happens when there is more of something? The price of that something goes down. Well, here's the dollar index. Here's the dollar. Here's the U.S. dollar over the last year. In fact, if we look at the U.S. dollar, it's losing its value, right? If you look at over the last 3 years, look where the dollar is doing. So when there's more of something, because we keep printing U.S. dollars, well, we actually don't print. Well, we just add it to our ledger and then, put it out into the system. That's trillions of dollars going into the system. That's the argument for gold bugs and, Bitcoiners and Ethereum holders, is because, right, debasing of the currency, devaluing of the U.S. dollar, you as a consumer is losing buying power by 6-7% a year. The government says inflation is under control. That's completely bullshit. Nothing is under control because of the national debt. The national debt is going to keep growing and keep growing and keep growing, regardless of who is in charge, until that's fixed. Now, this administration's point is, well, we don't need to fix the national debt. Actually, national debt, they're saying, at 125% of GDP is not that much. Okay, well, if our GDP is about 30 trillion, our debt at the moment is just about to hit 39 trillion, right? Now, what will happen to that debt to GDP if the economy slows down? Since we're 75% consumer spender economy, what if the consumer slows down? What if we get in a recession? Do you think we're going to produce 30 trillion in GDP? No. What if AI is a bust? Because most of the GDP growth this year is coming from AI spend, right? And last year. What happens then, right? I mean, again, I'm not a gloom and doomer, but you have to think about these things, right? We have 39 trillion in debt to be 40 in 100 days and 41 in another 100 days. So the debt's going up, national debt's going up, $1 trillion every 100 days. Well, that's, Elon Musk talked about this. He tried Doge and didn't work out. And he goes like, hell with this. Because Washington likes spending money that they don't have. Whose money is that? It's your money, folks. It's your tax dollars at work. They squander it. And then they have to go borrow another $2-3 trillion a year in order to close that deficit. Well, okay. Well, we keep doing that, then yeah, that's why gold is where it's at. That's why people are expecting Bitcoin to be 1 million. I'm not sure about that. We'll talk about that. That's why the U.S. dollar is losing value, and that's why you're losing buying power. And that's why all asset classes are very close to all-time highs. And as long as that continues, I believe asset classes are going to keep going higher because there's so much more money in circulation that that money is going to chase return. And when that chases return, that's what's going to happen. I mean, I don't see it any other way. And so this administration's point in all of this is, well, we'll grow out of it. Okay. Well, how do we grow out of it? Okay, so in order to lower the debt to GDP, we have to grow the economy faster. Maybe they will. Maybe all the plans they have in place is going to do that. Maybe we are going to accelerate GDP growth to maybe 4%, 5%, 6% annually. In order for that, I mean, I have to see it to believe it, but I haven't seen it yet. But although GDP growth is accelerating, what's going to happen is that the debt and deficits are accelerating as well. So that better happen quickly because the debt's not waiting. And the biggest part of the national debt that is a concern to me is the servicing of this debt, right? Because these are all IOUs we have spread all over the world, and including U.S. pension plans and sovereign wealth funds and things like that. Okay, well, if we put our future into some foreign land's hand, some foreign entity's hand, because they bought our bonds, because we like spending money we don't have, well, we have to pay them interest. And that interest cost is almost double our military budget, right? It's about 1.3 trillion last year, and it's going to be about 1.6 trillion because the national debt keeps growing and we keep issuing these bills, notes, bonds, and then we have to sell them. Well, the buyers of these at some point may require or may insist to for a higher return, and that's why the Fed cannot control, the interest rates, right? The bond market's way too big for interest rates for the Fed to control, and this is the TLT going back 30 years. Whereas interest rates are high compared to 3 years ago because TLT was 109. Now we're at 90. That means interest rates are higher. Again, this is an inverse index, by the way. And if we look at 10 years, this is the pandemic, right? In 2020, where interest rates were lowered to zero. And then look where we are. Interest rates have been going higher ever since 2020. So TLT going lower means real interest rates are going higher, right? And if we look at an all-time, what's happening to interest rates? Well, we are back to 2002 levels of interest rates, right? Here we go. Sometimes it's good to pull back and look at, have a historical perspective of where interest rates have been. But since 2008 GFC, which is this point right here, we've been basically living in a very low interest rate environment that's been induced by printing and spending, right? Print and spend, and it hit its pinnacle, it hit its peak in year 2000 with the pandemic, where Fed had to come in and save the economy pretty much. And since then, interest rates have been going higher and higher and higher. Now, historically, 5%, by the way, is not that high. If you go back to 1979, 80, during Volcker times, we had 20% interest rates. I mean, that was because inflation was completely out of control. But now, people call 5% high. Well, not really. If you lived through 1979, I was a young person then, but I do study history. And so interest rates to me are definitely should go lower, but in order for them to go lower, we need to have fiscal discipline. We need to have monetary discipline. And I think both have left the building. I don't think we're going to get that. Definitely not fiscal discipline. And monetary policy follows fiscal policy. And our fiscal policy is what? Print and spend. Because we're running a $39 trillion national debt. So that's interest rates, folks.